Okay, and the live stream should be starting in just a few seconds. Okay, and I'm opening the webinar. And you're welcome to get started.
All right, are we on?
Yeah, you're welcome to get started.
Hi, everybody. Welcome. I'm just going to give people a few minutes to come into the program, and then we'll get started. Okay, I guess we can get started. Welcome, everybody. Welcome to Tax Impact of the Inflation Reduction Act, our tax section program. I am Michelle Weiss. I'm the chair of the tax section, and thank you for joining us today. Before we begin, we have a couple of housekeeping announcements. You'll receive your MCLE certificate shortly after the program. Your certificate will also be stored in BHBA Plus, our members only community. Please take a moment to complete the survey that is included with your certificate. This program will be available in a couple of days in BHBA On Demand, BHBA's newest member benefit presented by Lawyers Mutual Insurance Company. The tax section is sponsored by Hochman, Salkin, Tasher, and Perez. The Hochman, Salkin, Tasher, Perez advantage is experience, an eye for innovation, and a genuine dedication to clients, their families, and their businesses. In addition to their national practice in civil tax and criminal tax controversies and related litigation in federal and state courts, the firm is also active and successful in handling non-tax matters such as business and estate planning for high net worth individuals and closely held businesses, together with white-collar defense and commercial disputes. Okay, and now we will go on to our program. I want to present the speakers. I will be speaking today, but our other speakers, speaking of Hochman, Salkin, Tasher, and Perez, we have Phillip Behrendt, who's an attorney at Hochman. Phillip is licensed in California and Germany and assists in advising clients in civil and criminal tax controversies, as well as international money laundering investigations stemming from tax avoidance structures. He also focuses on the technical aspects involved in advising voluntary disclosures in connection with DFIS, NFTs, and other crypto assets. Prior to joining the firm, Mr. Behrendt worked for more than 5 years in a leading German tax firm. He's experienced with handling complex voluntary disclosure interests for U.S. and international companies, representing clients in Germany and in German tax and criminal courts, and so on. He has worked with clients and client tax teams throughout Europe, the U.S., as well as in the Arabic region. Also speaking today will be Levon Lawson of Lawson Tax. Levon provides tax counsel and representation to businesses and individuals in tax controversy and litigation matters. In this capacity, she handles federal and California state income, employment, and transfer tax issues. Her practice involves many matters involving international asset and account reporting. She additionally provides outside counsel services to small and growing enterprises. She's a former senior attorney with the IRS Office of Chief Counsel, and she's been active in a number of professional organizations and bar associations. She is a former president of the Beverly Hills Bar Association and previously served on the board of trustees of the Los Angeles County Bar Association. She's very active in bar association. She holds a BA in economics and English from Stanford University and a JD MBA from Duke University School of Law and Fuq School of Business. So with that, we are going to start our program. And I think what we'd like to do, I'm just going to give an overview of what we're going to be talking about today, and then we'll dive in. That we're not necessarily discussing every single aspect of the Inflation Reduction Act. We will spend a bit of time talking about the IRS budget that is increased through the Act. We'll be covering other areas such as energy credits and some other points involved in the Act, including, and if you can, Kathleen, if you can pull up slide number 2, we have the roadmap. So if people can see that. We're going to talk about an overview of the Inflation Reduction Act, which I'm discussing now, its impact on audits and enforcement, the excise tax on repurchase of corporate stock, the extension of limitation on excess business losses of non-corporate taxpayers, the increase in the research credit against payroll tax for small businesses, and energy and environmental related tax provisions. And then there are some other provisions that we'll talk about if we have time. And with that, I'd like to pass the baton to Phillip. And if you could please, we could kick off the discussion about the IRS budget.
Sure. Kathleen, if you could move one slide.
Phillip, I think you're muted somehow.
I'm muted.
No, I can hear him.
Okay. I hope everyone else can hear me.
Yeah.
So that's the overview of the Inflation Reduction Act. I think many of us have heard about it and read about it. And I know for some people talking about budget, numbers of employees or audits might be dry. But it is very exciting for us, at least while we are preparing that presentation. We could have talked hours about that, and we hope to transfer some of that excitement to you today. At least after years of shrinking budget, backlog of modernization, reduced services that resulted in millions of unproceed paper tax returns and unanswered calls, the IRS finally received budget desperately needed to enhance their services. Can you move one slide, please? Because there we see the budget. The cornerstones have been portrayed in media. Everyone is probably aware, nearly 80 billion additional funding for the IRS. Most of it goes to enforcement. But if we are going into a deeper dive, yes, most of it goes to enforcement, but also 25 billion goes for operational support such as rent, printing, postage, security, 5 billion for IT and callback system modernization, 3 billion for pre-filing and taxpayer services such as pre-filing assistance, account services, and taxpayer education. The congressional research report shown here shows how significant that increase in many ways is. Commissioner Rettig called it, with this new law, honest taxpayers will see badly needed, meaningful service improvements at the IRS. Some of us might ask, why is the 10-year period important? Well, investment takes time. To develop and implement hiring takes time, recruitment takes time, training takes time, improving IT services takes time. And Congress basically has the power to shift the allocation and ministerial directives are not legally binding and can be changed by any time by Congress. So taking the budget away can undermine the efforts, and even the anticipation may stop investment before it even began. So it's crucial to secure the budget. And it even may pay off. So Congressional Budget Office expects an additional revenue of $204 billion by these investments. The White House claims that $124 billion will generate from collecting taxes already owed by wealthy individuals and large corporations. Which brings us to the first investment. Can you move one slide, please? The employees. We all have heard that there's an army of 87,000 IRS agents combing through the neighborhoods and collecting taxes. That is, excuse my French, bullshit. And the budget is for new employees. Yes, the IRS received direct hiring authority earlier this year through the Omnibus Spending Bill, and to bring thousands of employees to answer phone and process tax returns. Actually, right after the Omnibus Spending Bill was enacted, the IRS began holding job fairs in Ogden, Kansas City, and Austin, where the large submission processing centers are located. And the IRS didn't get a greater directing hiring authority or streamlined critical pay authority by the new bill, but they get the budget to finance it. So let's start and taking that earlier comment apart. 87,000. The number is based on a projection shared by Treasury Department May last year, for the American Families Plan tax compliance agenda. That projected 87,000 FTE full-time term employees for 2031. The number is not set in stone, and it's realistic but ambitious that the number of employees will rise towards the next year, or towards the next year's 10% per year. That might be something we can expect. Can you move one slide, please? The next one is the term agents. Most of the articles focus on that 87,000 agents are hired. That is not true. Commissioner Reddick, in his recent op-ed published end of last week, made that very clear. Also, he did not object to the number of 87,000 employees, but he made clear that the primary hiring right now is accounts management, so taxpayer service-oriented roles, and also submission processing, so taxpayer service, answering phones and correspondence. These are functions that are hired primarily right now. So for other personnel, they don't have the direct hiring authority, but Office of Personnel Management, responsible for hiring, is able to offer these workforce tools to the IRS. And the IRS and Treasury are working with the OPM, the Office of Personnel Management, on securing the hiring authority for technical specialists and examiners for the next years. The next term I want to focus on is the term new. That term might be slightly misleading because the majority of the hires are to replace positions that are already there. So unconfirmed numbers estimate that around about 50,000 employees, IRS employees, will retire throughout the next 10 years, and they will have to be replaced. So that we definitely not see 87,000 new employees. And the last term I want to focus on, and probably the most egregious for many people, is the term armed. They are not an armed IRS force. The only people armed at the IRS are the 100 special agent for criminal investigation units. That's around about 3% of the entire force. And according to Treasury Department, approximately 1,000 special agents will be hired throughout the next years. So that brings the level of special agent back to where it was many, many years ago. And also here, it's often to replace retirees, not new agents. So since the majority of new employees are not hired for special agent positions, we will not see the majority of new employees carrying guns. Where's that coming from? It came from a job posting, similar to this one we are seeing here on the right-hand side. Because IRS CI agent have, of course, the duty to carry a gun. I mean, they have the authority to arrest, they execute search warrants, seizure warrants, they investigate money laundering, narcotics, and Bank Secrecy Act next to the tax violations. And consistent with any law enforcement agency, you can create out of that alphabetic soup of law enforcement agents, FBI, DHS, and so on. They, of course, have the right and the duty to bear arms. And that is where that rumor that IRS agent have the duty to carry guns comes from that job posting specifically made for CI agents only. The recent flood of false claims compelled many professional organizations to counter these. For example, August 22 last week, the American College of Tax Counsel urged Congress to stop their members from making false statements. That brings us to audits. You could move one slide. We will see the impact on audits and enforcement that the shrinking budget had over the last years. So significant increase in enforcement funding. Many critics of the IRA, the Inflation Reduction Act, claimed will now be used to go after mom and pop shops, after small businesses. So, but as we can see here, and be realistic, the overall audit rate fell from 0.9% to 0.25% between 2010 and 2019. It might be notably that the earned income tax credit audits are relatively high, with 0.77% still. But you might keep in mind that these are mostly subject to less intrusive correspondent audits. It's be done via mail. It's of little comfort for the people affected, but at least some. So what fell the most? Well, the individual tax returns. They are most complicated, they require more time, more sophisticated person, and the lack of trained personnel, leaving of trained personnel needs or will cause a large audit gap and also a large budget tax gap. Lavon, I think you have more information on that.
Sure. With respect to the tax gap, pursuant to a 2019 report by the IRS, there was an average, they estimated the average gross tax gap at $441 billion per tax year. That number was reduced to $381 billion, after taking into account enforcement, late payments, and so forth. But nonetheless, there is a significant tax gap that has been estimated by the IRS. So they imagine that would decrease some with the ability to increase enforcement. But I also wanted to make just a couple of quick comments too about the resources and so forth. In addition to seeing a reduction in the audit set forth in the slide here, I'm sure that many people have noted that sometimes it can be difficult to get the level of support that they would like to receive. And certainly with this funding, hopefully we'll be able to see in the near future kind of, more support, in attempts to reach the IRS to process things. I know they do what they can. And also there have been processing issues, and hopefully those can get resolved sooner rather than later as well. But in addition to the tax gap, I want to turn this back to Phillip.
That we will see the majority of audits going after the wealthy people or corporations or complex partnerships. It's consistent with what was published so far. In the Treasury Department, Treasury Secretary Yellen's letter recently, she directed the IRS to seek teams of so-called sophisticated revenue agents to spend thousands of hours poring over complicated returns. So that are returns of wealthy individuals, corporate, complex partnership. So they will be at a higher rate of being audited in the future. But what is now with small businesses and workers? So published, first announced by President Biden, was, and maybe you can, Kathleen, can you move one slide, please? So we will see how Treasury Secretary Yellen repeated the president's pledge to a cut-off number of household earnings less than 400,000. That might be very hard to observe. I think we all agree on, so at least on our panel, we have discussed that extensively. We agree that that number will be very hard to observe. It's impossible to know whether or not an income is less than 400,000 before you are finally audited. So that means either you include numbers less in the audit, or you provide even an incentive to understate one's income. In other words, so if I made 410,000, I might have an incentive to get under the 400,000 threshold and now understate my taxes in order to reduce my risk of being audited. So I'm pretty sure we can see that the 400,000 will not be a safe harbor. What is more likely is that the IRS is not focusing at that level because they are much more important opportunity above. And says the tax gap is higher above, the projection tax that can be gained through doing an audit might be way higher in these complex returns than in the simple return. However, you might see two factors that may cloud the perception of the corrected audit, of a correct audit rate during the next years. And that is, first, what appears to be an audit is not always an audit. What do I mean? So the pledges made refer to audit rates. That suggests that they refer to audits in a legal sense, that it's counted in IRS statistics. Examine specific items is in way more possible than just through audits. So automatic notices, verifications via simple letters, for example, the mass error occurred, or if the difference between the W-2, the 1099, and the reported income, or so-called soft letters informing taxpayers that the IRS believes that there has been income unreported. We have seen that in cryptocurrency cases recently. So that does not technically count as audit, but it might feel as an audit. And with the backlog being resolved through more personnel, we might see these letters a little bit more than during the next months or years. But I think we can state that the W-2 and 1099s reduce at least the chance of being audited significantly for workers and wage earning taxpayers and so on, because the IRS already has a third party verification they can use to compare your income. So a second point that might cloud the perception is that the IRS already has initiatives to increase audit rates. For example, of partnerships. Last year, the IRS departments LB&I and SB and SE launched an initiative to focus more on partnership compliance. The Bipartisan Budget Act, BBA, has a partnership centralized audit regime. The focus will be on issues such as signing authority, substitution of partnership representation, and also administration adjustment request, which is basically the equivalent of an amended return under the BBA. And that initiative is already underway. Hiring took already place, at least partially. And adjustments to observe the pledge made by President Biden might be possible, but we will see how that turns out. So what that brings us to the probably more important question, or most important question. Kathleen, if you could move one slide, please. What is next? So forthcoming, IRS is directed to prepare a detailed report. The report will shed light on the intended use of the additional funds. The Treasury Secretary requests a detailed plan within 6 months. A deadline that was included, by the way, in an earlier version of the Inflation Reduction Act, but then became the victim of the so-called Bayard rule, a rule that prohibits reconciliation bills from including provisions that do not affect spending or provisions whose revenues are merely incidental, and therefore was not included, but Secretary Yale made clear that she is sticking to that 6 months rule. So the IRS will work with tax professionals and other organizations throughout the process. And additional information will be released over the coming weeks and months by the IRS. And despite the cash infusion, things will not change overnight. The IRS will develop a plan, they have to implement it, IT systems needs to be updated. So what we see they are starting is they will reinvest in their HR office. They will work with outside contractors. They will coordinate recruitment, onboarding, and training. And the priority, as mentioned earlier, and that is consistent with Lavon has experience, or we all have experience probably, the focus is on backlog and phone service first. The IRS, at least to my information, seems to target a level of service rate of 85% on toll-free lines. So that will be a significant change to what we are experiencing right now. So overall, the first year spending will be moderate to the years later coming, because they probably need to focusing first how they want to spend money, not to spill too much money in the process. In other words, the audit rate is not expected to be skyrocketing next year. And Commissioner Rettig, for example, suggested enhanced IT system and taxpayer services will mean that honest taxpayers will be better able to comply with tax laws, ultimately result in a lower, that he emphasized, yes, lower likelihood of being audited and reduced burden on them. So, but again, all of that needs time. Hiring and training of new employees takes up to 3, 4, 5 years. And after that long period, or throughout that period, the figure of audited large corporation, wealthy individual, and complex partnership tax returns will rise steadily. In my personal opinion, also individuals with suspected unreported offshore assets or involved in transactions listed as so-called dirty dozens will almost certainly face additional scrutiny once the IRS has more manpower to investigate. And with more resources and improved automation to detect such assets and transactions, audit and enforcement actions are likely also to increase. But as Lavon mentioned rightly, more resources provide needed assistance for current IRS auditors, IRS employees, and especially also for taxpayers alike. So what's not in the bill is there's no additional funding for guidance. So additional guidance, especially for the tax provisions we will discuss next, might still take some time. And Michelle, Lavon, that's your turn.
I just want to make some comments following up on what Phillip said. Is aside from the fact that a lot of more experienced IRS personnel are retiring, appeals officers, revenue agents, and so on, the complexity of the tax law is so much more now. We look at NFTs or international transactions, and just being able to get up to speed requires more resources. So it's not as if suddenly the audit rate is going to skyrocket. It's just maybe they'll be able to, wrap their hands around what's going on. The other thing also is they fell so horribly behind during COVID. I know I've discussed this with my colleagues that particularly penalty abatement requests and refund requests that were sent in since the onset of COVID have not been worked on. They're just really slow. We all read about these truckloads of mail that are sitting unopened, and it's really to the taxpayers' advantages to get these things opened and processed. Things cross in the mail where you resolve something and it doesn't get processed properly. So the taxpayer gets some notice about a collection issue or some other thing that was resolved, and the systems and the the resolution doesn't cross. And so, you know, my hope, I think the hope of a lot of tax practitioners is that the funding will help them at least get up to speed just to be where they should be at this point, because this backlog is just, it's already over 2 years and it's not resolving so quickly. So, you know, I would hope that they would be able to this will help them get to where they need to be. So just my opinion on it.
And just a reminder that there are a plethora of different departments associated with the IRS. I mean, it's just an enormous organization. And so just kind of going, again, thinking about the support, there's also with increased funding, there's increased support for people that can help resolve issues, whether you're dealing with appeals or dealing with someone at a service center. There's just more people that can help to process, but also to help taxpayers. Even getting information, even say the disclosure office, there's just so many departments. And right now they've just, as you saw from Philip's handout, there was such a reduction in force, or just, you know, over time, you know, any additional support will help taxpayers going forward as well. Did we have anything else on this, Philip, or
no? We can proceed with the excise tax.
Sure. Okay. And so I just wanted to, and Kathleen, if you would go forward a page, and Michelle is going to, you know, this this act rather has various tax provisions, and there's a plethora of energy provisions that Michelle's going to discuss. But there were a few other things that we just kind of wanted to bring to your attention as well. This is really an overview, but there are things of interest to different sorts of taxpayers. And one of the changes is actually a new tax section. This is an excise tax on stock buybacks. So this is a tax that imposes a section that imposes, and it's Internal Revenue Code section 4501, and it's new, and it imposes a 1% tax on stock buybacks of domestic public corporations, and it's imposed on the fair market value of the stock that is repurchased. So, you know, I guess there's a number of questions that are associated with the section, a number of basically exceptions and so forth, definitions, but kind of in broad strokes. This is a non-detectable excise tax. And the history of this is the same language as what was set forth in the Build Back Better Act. The proposed policy goal is to raise revenue and to promote reinvestment of funds in employees and the business rather than in buybacks. The proposed, I think that for the revenue that they're expected to raise pursuant to this is $74 billion with respect to the raising of revenue. The effective date is after tax years after 2022, so it would be effective after this year. And currently, there's no grandfather rule. So, for instance, as for buybacks that, let's say, had been approved in 2022 but not yet implemented, there does not seem to be a grandfather rule with respect to those. Bring to your attention a quick typo just so that you know in advance. Under effective date, where it says grandfather rules, such as for buybacks approved prior to 2022, not indicated, that would be buybacks approved prior to 2023, not indicated. So, and by the way, in the secretary has been charged to provide regulations and guidance with respect to these provisions. One, to help taxpayers make sense of it. Two, to prevent abuse of exceptions, and to address, you know, special classes of stock and the application of rules regarding stock of foreign corporations. So what is this? A covered corporation for these purposes is a domestic corporation for U.S. For certain non-U.S. corporations that are treated as domestic corporations pursuant to the inversion rules. And in limited circumstances, it would also apply to foreign affiliates. A repurchase is defined as basically two things. One, by reference to section 317B, which addresses redemptions and defines that the stock shall be treated as redeemed by corp with the acquisition of stock in exchange for property. But there's also the kind of an open-ended definition, which is, and including any definition determined by the secretary to be economically similar. And so you can see why guidance would be needed. But there are a number of exceptions. One is the first $1 million, and Kathleen, if you could go forward a page. But the Exceptions include $1 million, first $1 million of stock repurchases are not included or accepted from this. Another one is stock that's been repurchased for purposes of an employee-sponsored retirement plan or employee stock ownership plan. Those are accepted for these purposes. And so, an outstanding question there could be, to what extent, like how broad is the definition of employee stock plan for these purposes? So guidance will be much appreciated. And of course, there is an exception for the repurchase of stock pursuant to a tax-free organization under Section 368A. Additional exceptions listed here: repurchase by a dealer in securities in the ordinary course of business, a repurchase by a regulated investment corporation or real estate investment trust, and then also a repurchase that is treated as a dividend as opposed to a sale or exchange. So that goes to outstanding questions that so far that I have. I know there's a number more, and I do wonder about transactions that were approved prior to 2023. So we'll see what happens with that. But that is, that's the excise tax on corporate buybacks. Corporate buybacks have been somewhat of an issue. So that's a response to that. And then going forward to the extension, this one is, there is a provision in the Act regarding non-corporate taxpayers. And really, it has to do with losses that are claimed and extension of the limitation. So this is the excess business loss deduction under this. And an excess business loss for these purposes is a loss where, to the extent where you take total deductions attributable to a trade or business, to all the trades or business of the taxpayers. And after you subtract total gross income and gains with respect to that taxpayer, that difference plus an additional $250,000 for a single for a single return or $500,000 for a joint return. Any amount above that difference is an excess business loss that is suspended and can be taken the following year as a net operating loss. And so the purpose of this is to ostensibly to reduce the ability for high-end taxpayers to offset their other income. A trade or business for these purposes for that taxpayer is Schedule C activities, Schedule F activities, certain Schedule E items, and more. And this provision is expected to raise $53 billion. I guess with respect to this one is a quick history of this is simply that this was a limitation, was part of a number of limitations with respect to non-corporate taxpayers implemented in the Tax Cuts and Jobs Act, Tax Cuts and Jobs Act of 2017. And so at that time, it was implemented for years beginning after 2017 and ending in years prior to 2026. But with the CARES Act, that got amended so that it started a little bit later as a relief provision for individual taxpayers. And so the CARES Act had this get implemented as of 2021. The American Rescue Act extended the limitation to years prior to 2027. And so this provision has been completely decoupled from some of the other limitations on deductions for individuals, but finally under the Tax Cuts and Jobs Act. But with respect to this particular limitation, it has now been extended another couple of years. So at the end of the day, what this really means is that for periods from 2021 through 2028, to the extent that there is an excess business loss deduction, again, it's to the extent that your losses exceeded the income and gains plus $250,000. If you have losses above that, they just are suspended and taken as a net operating loss in the next year. So that's what that is, and that is the amendment to Internal Revenue Code Section 461L. And then we have something for small business that may be of interest, and certainly it may be it'll be a benefit for some of your clients. So to the extent that you have clients that fall within this, I hope you get a chance to review this with them. And this has to do with a payroll tax credit that's available basically to startups involved in R&D or who have R&D expenditures. So Section 41, which has to do with the research tax credit, is amended under this act to increase the maximum tax credit that can be used to offset employer taxes, increasing it from $250,000 to $500,000. So the effective date for this is for tax years beginning after December 31, 2022. So essentially for next year. And thank you, Kathleen, for forwarding that. I should have asked you. So who can take advantage of this? It's basically, this is for a qualified small business, and you don't have to be a corporation to take advantage of this. But a qualified small business is defined as a corporation, including S corporations or partnerships with gross receipts of less than $5 million in the tax year, and who also did not have gross receipts 5 years prior to that tax year. So that's why I think this is clearly for startup organizations, but it's a wonderful benefit. But again, you don't have to be a corporation or partnership. It's also for any other person that can meet those requirements, taking into account the aggregate gross receipts received in all of that person's trade or businesses. Not included is an exempt organization. So an exempt organization doesn't get this benefit. But what this does, so in the application of this credit, the act, in addition to increasing the total amount of the payroll offset on taxes, they also are now extending it to Medicare. So it can be applied against Social Security and against Medicare to the extent of the employer side. To the extent that the credit exceeds the payroll tax, then that would be forwarded to the next quarter. So I guess it's so kind of, again, just as a summary, this doubles the amount of R&D credits available for payroll offset. And when you consider this is that there have been other acts that have been passed recently, such as there's a Science Act that's been passed, and Michelle's going to discuss a number of credits available with respect to energy provisions. This is a good time to review with those clients who are involved in R&D activities. So that's what I have for that. We have some additional provisions toward the end that we'll also review very briefly, because we just wanted to make sure this overview was available in terms of what is covered in terms of tax provisions under the Inflation Reduction Act. So Michelle, what did you have for energy? Oh, I see there's, go ahead. I'm sorry.
If Kathleen, you can move to the next slide, please. Or slide 16, I should say. Whoop. Slide 6, there we go. Okay, so there are many provisions that fall under the rubric of energy or environmental related tax provisions. What most of these are doing is giving taxpayers, different types of taxpayers, incentives to engage in business or activities that are environmentally friendly. There's provisions for energy producers, so that I broke it into, and I'm not going to go through every single one, because there are very, very many, and this could really use a deep dive just into this alone. But there are, and on this slide, I just have an overview of what's going on. There's a lot of extensions of credits, and really trying to encourage taxpayers who are in the industry of alternative sources of energy to get their businesses up and running. So Kathleen, if you can move to the next slide. Something new that these provisions have is a direct pay or transferability of credits, and this applies to the energy producers, which we'll get to in a minute, where people who qualify for these credits can get an immediate refund of them, as opposed to waiting to have some kind of income to offset, or they could actually transfer the credits to a third party and get paid for the credits by the third party, and that amount of whatever they get for it would be non-taxable, wouldn't be included in their taxable income. So the idea here is really to get money into the pockets of the people who are engaging in these types of businesses, so that they can get their businesses off and running with these credits. So if you can please move to the next slide. So there are lots of tax incentives for the energy industry. There's a modification and extension for businesses that engage in alternative sources of power, wind power, solar power, geothermal, biomass, trash combustion, landfill, gas, hydropower, and wave and tide power. It extends it. This is under and many of the provisions are in Code Section 45 with a capital letter after it is the area of the code that has many of these provisions, some of them modified, some of them new. And many of these provisions also, and I won't necessarily go through all of them, you can read them here, have a requirement that these energy producers comply with prevailing wage requirements and also offer internships. So this is, I guess, the Inflation Reduction. I don't know, maybe it's giving people jobs. It's a way of trying to, I guess, do two things at the same time, is encourage taxpayers to both develop and continue and expand these alternative fuels, and also try to get people employed as much as possible and properly. If you can please move to the next slide. And it's also, these are the credits that, that would, the ones that have the ability for direct pay and transferability also tend to be the ones that have the prevailing wage and apprenticeship requirements. So here are some more of them. It's just different types of credits for different types of producers of these parts. If you go through all this material, you'll see also that where something is being produced, there's this emphasis on, and then it also has to be produced in the US or extracted from a US source. So there's also this movement, just like with research and development credits, for example, to expand this technology in the US. So if you open such a facility not on US soil, you're not going to be eligible for the credit for the most part. If you can go through all the information I put together, I don't need to read it to you, but you'll see that these are the requirements for most of these. And if you can please move to the next slide. There's some more tax incentives. There is, so I look at this as using the carrot rather than the stick to incentivize people to engage in these types of technologies, rather than, maybe the EPA has problems now after the Supreme Court case with having some of the teeth that they had before to be able to do all that they need to do. This is encouraging it from the other side. Instead of slapping someone on the wrist for not doing something properly, you get a gift for actually engaging in activity that is desired here. There is one stick that I saw, however, which is a reinstatement of Superfund hazardous waste tax of 16.4 cents per barrel. And I think there's another one, and I think, Levon, you have it later, about something involving black lung disease with the energy credits. But for the most part, all of these are credits and incentives. So these are the credits and incentives for the energy industry or energy producers. And if you can please move to the next slide. Okay, so now we have incentives for individuals. So there are two areas that there are these incentives. Some of them are residential, and then we're also going to get to clean vehicles, which we'll talk about in a minute. But these are various credits and incentives to have fuel efficient homes, that they talk about the energy property credit or extension of residential energy efficient property credit. If you're building a home, this is an incentive to have your solar panels, your, things that meet certain standards of energy efficiency in your home. And these are all ways that in building your home, you can try to get there, and maybe the credits can help you. They're not that much. I mean, a $5,000 credit for a home, depending where you are, that's really not going to make a big difference in terms of how you decide to go about it. But maybe depending where the building is located, where your home is located, that could make a difference. And certainly, every little bit helps. If you can move to the next slide, please. So this is the tax incentives for individuals for clean vehicles. A little bit, I think of this as the anti-Tesla provision, because while it looks like it's helpful, it's really not so much. So it eliminates the limitation on the credit after the car that you're purchasing is from a producer that has produced at least 200,000 clean vehicles. So that sounds like a good thing. And it's up to a $7,500 credit, and it's broken down into two categories based on the materials in your battery. And so that sounds like a good thing. However, there's a limit to who qualifies. And so the credit phases out as taxpayers' income increases, with a complete phase out at $300,000 for a joint return and $225,000 for a head of household return. So in reality, since these cars tend to be more expensive, the question is how many people will actually, who would be purchasing these vehicles, would actually qualify for the credit. Similarly, how many people who qualify for the credit could actually purchase these vehicles. And there's also a limit on the price of the vehicle, which is that the retail price of the vehicle cannot exceed $80,000 for vans, SUVs, and pickup trucks, and $55,000 for all other vehicles. And so certain high-end brands like Tesla, for example, aside from the fact that somebody wouldn't meet the income limitation, it's unlikely they're buying these cars. There's also a requirement that the minerals be extracted or recycled in North America, and the battery to be assembled or manufactured in North America. So that also places a limitation on which vehicles are available. However, the IRS did release guidelines. It's on the IRS website in the form of FAQs about which cars would qualify based on the price and where they're manufactured. And it'd be interesting to understand what manufactured means, because I remember the Bausch & Lomb case with twisting glass. If you just twisted glasses in the US and somehow was manufactured in the US, I remember from tax case probably like 15 years ago. So, we need guidance to understand what these things mean. There's also a credit for previously owned clean vehicles, and this is something that's needed because they're a recent item, and now there are pre-owned vehicles that you can buy, and so this helps. And then there's also a credit for putting in it's called an alternative fuel vehicle refueling property credit. That's, when you have a plug to plug in your electric vehicle. So it's a limit of $1,000 per residence, but the residence has to be located in a low income community or a non-urban area. So doesn't apply to a lot of people. There's also a similar credit, which we'll get to for businesses, that has a similar requirement. Okay, if you can move to the next slide. Okay, so here we have various tax incentives for businesses. There's an energy efficient commercial buildings deduction, which has to do with if you're building a building, if it meets certain energy efficiency standards, you can get some credits for it, and that's helpful. And you have an accelerated 5-year depreciation on the building. That's an amendment to Section 179D. That's actually something that can be very helpful to businesses. It's a very quick depreciation. And again, there's a qualified commercial clean vehicle credit, which is similar to the credit for individuals for cars, and the alternative fuel vehicle refueling property credit. It's much higher for commercial buildings. The previous law had this limitation that it can only be one per building. That rule has been removed, and it also increases substantially, but at the same time, it has to be in this it needs to be in what's called a census tract location. Again, it's a non-urban area or low income community, and it's subject to prevailing wage and apprenticeship requirements. So again, a lot of these credits sound great, but when you start going down into the fine print and look at all the restrictions involved of what you have to meet to be eligible, a question really arises as to how many taxpayers really can be eligible for these credits. So that's something that you would need to discuss with your client before they get overexcited about seeing these new credits, are they fitting within all the guidelines to obtain the credit? Can you please move to the next slide? And so that's all that I have for the energy credits. There's one other thing I'll talk about, and I'm giving this I'm just literally mentioning it without doing a deep dive. But of course, there's another thing is the corporate AMT for tax years beginning after 12/31/2022. It's a 15% corporate alternative minimum tax on adjusted financial income of very large corporations. So it's generally for corporations reporting at least $1 billion average adjusted pre-tax net income on their consolidated financial statements. This applies to very, very few taxpayers. Maybe, I think we were talking about it was about 100, a little over 100, maybe 125 companies that actually might be subject to this. And they could owe the corporate AMT when they have significant permanent or temporary book tax differences that cause financial statement income to exceed taxable income during a year. So that's what you're looking at, is when does financial statement income exceed taxable income during the year is where this would kick in. And with that, I think, Lavon, you wanted to mention some other provisions in the Act?
Kathleen, if you could just forward one page. And okay, so it's not there. Well, we just for purposes of completeness, and just kind of note that hopefully with there'll be additional guidance coming forward soon, and hopefully this section will have a program which will focus more on some of these issues and in depth, such as, for instance, the 15% AMT that Michelle just described. But just wanted to bring your attention, there were some other items under the Act as well, and some of these really were continuing certain health provisions. But I think, Michelle, you referenced, for instance, the extension of the increased rate of the coal tax fund, Black Lung Disability Trust Fund. So there are those who want to bring to your attention. There's a premium tax credit that gets extended with respect to healthcare. There's an excise tax on certain drugs during a non-enforcement period. And there's a safe harbor for, I guess, certain plans that may not include a deductible for insulin. There's just, I think what one wants to do, and we didn't get it into the materials where I think it would have been more helpful, because I'm just really just kind of naming them without really describing them. But just to let you know that there are these other provisions as well. And we just want to let you know what was out there with respect to the tax portion of the Inflation Reduction Act. Again, we'll be coming, I imagine this section will be coming back soon on a program to get into some of these areas, more completely. So as opposed to an overview that we're providing. But Michelle, I think that's kind of what I had. I don't know. Go ahead. One
other comment on the healthcare, on the pharmaceuticals. The excise tax meshes with the provisions involving capping drug prices, I believe. And there's this measure where these pharmaceutical companies have to enter into some sort of an agreement. I think it's with the US about government, I forget which agency, about how much they're going to charge for certain medications. And if they don't enter into the agreement, which is what you were referencing, by a certain time, then they will be subject to an excise tax. So that was that provision. And there are more provisions in there. It's a very extensive bill. And Philip, if you want to just jump in.
Yeah, I think we are moving to the Q&A. We don't have much time, but I saw from Mitchell Miller, the question about the LB&I hirings. I have no information about the boni, but there is an IRS Next initiative that already started, I think, end of last year, hiring. So the LB&I, for example, this year alone, hired 40 external people with prior partnership experience and will conduct training sessions. I think they have started already this summer, where existing employees who have been focusing on corporation audits so far are refreshing their partnership audits. They also have a second initiative besides the BBA audit regime. They have before the Inflation Reduction Act came, they also had the LB&I Global Health Wealth Program, and they hired economists for transfer pricing issues there too. So they are hiring on all levels, also experienced personnel.
Yeah, and the other question that Mitchell had to do with bonuses. I know back in the day, they had various types of performance awards, which came with some money. And I recall that at some point they canceled that program. So I don't know if they brought it back. I don't have information about that. So I guess with that, I want to thank everybody for joining us today. If you're interested in becoming more involved in the tax section, please reach out to me. We have our monthly meetings at 8:30 a.m. on the third Thursday of every month. It's on Zoom. And on September 6th, we will be having our monthly tax program, which is on the first Tuesday of every month. And we will have a program on foreign beneficiaries of S-Corps and partnerships. And with that, I want to thank you for joining us and wish everybody a wonderful day.
Thank you. Bye, everyone.